I invest for cash flow. One day, the cash flow that I receive from dividend-paying stocks will exceed my living expenses. Hey everyone, this is Ian from ppcian.com, back with another video about dividend growth investing. I'm an investor who loves dividend-paying stocks that increase their dividends over time because I invest for cash flow. One day, the cash flow that I receive from dividend-paying stocks will exceed my living expenses. More than that, it will give me flexibility to donate even more money to charity, to causes I truly care about. Today, I want to discuss my personal criteria, my top 8 criteria for choosing dividend growth stocks for my own portfolio. Keep in mind that my portfolio is built for the long run. I'm trying to accumulate a world-class portfolio of stocks that I will hold for 30 years or more. So that long-term time horizon really plays a big factor in all of the criteria that you're going to hear about in today's video. So number 1, I look for track record. I'm investing in companies that are going to be around. I'm investing in companies that I can trust, ones that grow their dividend over time, that have predictable earnings streams, that have predictable method to continue to raise earnings, continue to increase dividends. So I look for a track record. If a company is newer, maybe it's only been around a few years, maybe it just had its initial public offering, typically I will not invest in those types of opportunities, at least for my dividend growth portfolio. Obviously, as someone who spent a long time in the technology industry, someone who's a Silicon Valley tech executive, I do dabble in some tech stocks as well, but today's topic is dividend growth investing, and for dividend growth portfolio, I only invest in companies that have a proven track record. Now, what do I look at? I try to look at companies that have been around for decades. I try to look at companies that have grown their dividend over time, that have grown their earnings over time. I try to look for companies too that have weathered the storm. You've probably seen this in your own career. In life, there are cycles. There's times when things are going great. There's times when things are not going so great. Companies are not immune to these cycles. Every company goes through cycles, and I like to pick companies that have weathered the storm. I like to look at companies that have been through recessions, been through hard times, and have made it through stronger each successive time. So that's the first criteria that I look for in dividend growth stocks. Second criteria is debt. Right now, we are facing historically low interest rates. Very, very low interest rates. And maybe they'll be around for a while, but a lot of companies out there have taken on debt. They've taken on debt because the interest rates are low. They can take that debt, reinvest it in their business to grow their business. They can even buy back shares of their own stock. And because the debt interest rate is so low, it actually works in the favor of these companies that pay a higher dividend, because the interest rate they're paying on buying back their stock is actually lower than how much they'd be paying out on the same stock in dividends to shareholders. So fact of the matter is, a lot of companies are taking a debt-centric approach. Personally, that concerns me. I don't think interest rates will always be this low. I like companies that have a low amount of debt, a manageable amount of debt. And don't get me wrong, if some companies are taking on debt to buy back stock, shares of their own stock, I own such companies in my own portfolio. But I just want to be very, very careful that the debt level is not too high. So when I'm looking for stocks for my own portfolio, they must have a sustainable amount of debt. If it's too high, that worries me. Now, this varies industry by industry. One industry in particular that's notorious for having a lot of debt is the utilities sector. So that industry has to be looked at completely separately than some of the other sectors, such as consumer staples, for example. But again, debt. Look at the debt. Make sure it's not too high. That's something at least that I do every time when selecting stocks. Third criteria I look at is payout ratio. If a company is paying a really high dividend, maybe the yield is like 8% or something really high, oftentimes it's too good to be true. And the worst thing that can happen for a dividend growth investor is a dividend cut. I'm investing for income. I want the income to continue to come in. I don't want to experience a dividend cut. So I like to look for companies that have a reasonable payout ratio. And what this means is, as a percentage of all the income coming in, how much are they paying out to shareholders through dividends? Typically, if that ratio is somewhere around 50, 60%, that's good. If that ratio is up at 80, 90, 100%, that's bad. Because when you're leaving no margin for error, what if the earnings go down? They can't cover the dividend anymore. So companies actually that pay a lower payout ratio but have a history of increasing dividends over time, those are the organizations that I personally like the most. Sustainable payout ratio. Interesting side note here, my dividend income in the short run doesn't really matter. It's really what's my dividend income going to be in 10 years, 20 years, 15 years, 25 years. That's what matters the most. But present day dividend income, I'm not as worried. So that's why I'm looking for dividend growth stocks, because I know even if I sacrifice in the short term some yield by staying more conservative, by going with the companies that have a conservative payout ratio, I'm going to build a robust machine. I'm going to build a machine that can weather the test of time. But if I take on more risk in the short run, I buy some of those really high yielding stocks, maybe they can't even maintain those dividends. 15 years out, I'm not building a machine, I'm just taking short-term risk. So very fundamental to me, payout ratio. So that's the second criteria that I look for. Third criteria that I look for in dividend growth stocks, I look for really good margins. I want a company that has just built a machine. I don't want a company that's earning 10%. So every dollar of revenue that's brought in, they're only able to retain 10 cents of it. I don't want that. Why? Costs can fluctuate over time. Salaries can go up. Cost of raw materials can go up. All kinds of stuff. The challenge with a company with thin margins is it leaves very little margin for error. For me, I want a world-class enterprise that can weather the test of time, can have that track record for another 30, 40, 50 years. How is that achieved? By buying businesses that are built for the future. They're built strongly, they have competitive advantages. That typically shows up in the margins. So gross margins, net margins, I look for high margins. I look for the highest margins in the peer group, but also just when searching for industries, I navigate towards industries that tend to have good margins. I don't want to invest in industries that have very thin margins, and I do it sometimes, but most of the time I do not do that. I look for good margins. So that's my number 3 criteria is great margins. So another criteria I look for is just PE ratio. This typically depends on a few things. It depends on where the market's at. It depends on where a stock is at within the market. Sometimes it's based on industry. Tech industry tends to have higher PE ratios than maybe consumer staples. However, in general, I like lower PE ratios. Not only from a point of entry, but just from a company standpoint. I don't really invest in companies that have PE ratios that are very high consistently year in and year out. Why is that? I just don't feel like I'm getting a good value on my money invested. I like to get value. I don't like to pay a huge multiple. For those of you that don't know, it's just price divided by earnings, price earnings ratio. The higher the PE ratio, the more expensive the stock is. I'm a bargain shopper. I like value price stocks. So I will typically look for stocks that have reasonable or lower PE ratios. So PE ratios anywhere between 10 and maybe 18. Once you start getting much higher than 18, it seems a little bit expensive for me no matter how fast the company is growing. So another factor I look at is just diversification. So when I'm buying stocks, I not only look at the stock, but I look at my entire portfolio. I call my portfolio my dividend growth machine. I'm building a machine here, and a machine is built of its components. So I've got to diversify. I need to put different components into the machine. How do I diversify? First and foremost, I diversify by industry. I try to have representation from each of the industries out there. So you have industries like technology, healthcare, consumer staples, industrial, raw materials / oil, natural resources, industries like utilities. So there's many industries out there. You don't want to be overweight or underweight in any of them. Well, maybe you do at a high level. For example, healthcare might be an industry where I at least believe there's a big, bright future for healthcare, given just where we're at right now in a global economy and the population and the need for future healthcare services. So maybe I'm a little bit overweight there. But typically, I don't like to overweight too much. I keep it pretty spread out. So I like to diversify by industry. I like to diversify by market cap. I don't want all my companies I own to be mega large caps with $100 billion plus market caps. I like to have some companies that are mega, some that are kind of mid caps, so companies maybe between 10 and 30 billion. I like to have some smaller companies, maybe between 2 billion and 10 billion market cap. So I diversify based on market cap, and most of my holdings are bigger. They're the big mega caps. But some of them are smaller, and I try to diversify that way. One last point on diversification is I really think it's important to stay focused. In the world of dividend growth investing, if your portfolio is huge, maybe you can manage 40 or even 50 stocks. But for someone like myself, and I think most people out there watching today, keep it focused. Pick the best stocks. Maybe settle on something manageable. So these days I have a lot of positions. So for me to add more positions, I'm kind of at the point where I need to sell a position. I don't want to have too many positions. It's important for me in my diversification strategy to stay somewhat focused but still diversified. So that's how I look at diversification, and how I look and use diversification as a strategy when I'm adding new positions to my portfolio. Another strategy, I look for dividend growth stocks that have a competitive brand and a moat. I want world-class brands. This goes back to my first point about track record. I'm investing for very, very long time. I'm investing in stocks that have a track record, a great history. And so competitive moat is very important because it ensures the ability to continue to have a track record. If you don't have a competitive moat, you don't have a brand, someone can just come in, duplicate your business, and replicate it in many cases. So I look for proprietary technologies. I look for proprietary, maybe even government-mandated territories that they own. I look for real estate that is locked up, patents, trademarks, brand awareness, strong margins. This also reflects in strong margins. So competitive brand and a competitive moat is really important because I only want to buy defensible businesses. So last one today, and I don't remember, I kind of got out of order on some of these strategies and some of these criteria that I look at. There should be about 8 of them total. And don't get me wrong, there's more than 8, but these are just some of the top 8 that I want to share today. The last one is I like to buy companies that I love. Now this is risky because if you buy a company that you love, you also can't ignore the fundamentals. But I buy companies that I love that meet all of the other criteria, that have the fundamentals. This is really important because companies that I love, I understand. Companies that I love, I have experience with. Companies that I love, I'm going to stick with them in good times and bad times. In a great quality dividend growth portfolio, again, you don't want to buy companies where the dividends are going to be cut. You don't want to buy companies where you might feel compelled to sell them if times get rough. And if you love a company, if you understand a company, it's a company that aligns with your personal beliefs, I think it's a lot easier as a dividend growth investor to hold that company for the long run. So those are my 8 criteria that I personally use when I'm buying dividend growth stocks for my dividend growth portfolio. This is Ian Lopuk from ppcian.com. Thank you for watching. I invite you to please subscribe to my YouTube channel. More of these videos are on the way, and I will see you in the next video.